Most investors chase yield in the same places: dividend stocks, bonds, or high-yield credit. But one of the most overlooked income assets sits right in between them: preferred securities. Let's look closer at this unique asset class. In 2026, preferreds remain a hybrid asset class, combining features of both stocks and bonds. They typically offer fixed income style payouts, but with equity-like risk characteristics. And importantly, they represent a meaningful slice of the income market, with the ICEB of a preferred securities index historically delivering yields often in the 5% to 7% range, depending on rates and credit conditions. Now let's define what preferred securities actually are. Preferred shares pay dividends that rank ahead of common stock dividends. Sit-below bonds in the capital structure typically offer higher yields than the issuer's senior debt to compensate for added risk. Most are issued by banks and insurance companies, which account for the majority of the preferred market globally. From a credit perspective, many preferreds are rated below the issuer's senior bonds, reflecting their subordinated position. Yet a large portion still sits in the investment-grade universe. Why companies issue them? There are three key reasons. First, capital efficiency. Preferreds raise funding without diluting voting control like common equity. Second, flexibility in stress periods. Unlike debt, dividends can be deferred without triggering default. Third, for financial institutions, preferreds help meet regulatory capital requirements under Basel rules, especially for Tier 1 capital buffers. Why investors consider preferreds? Number 1, yield advantage. Preferreds often deliver higher income than traditional fixed income. For context, investment-grade corporate bonds often yield less than preferreds in similar environments. Preferreds commonly sit in the mid to high single-digit yield range depending on credit conditions and interest rates. This makes them attractive for income-focused investors. Number 2, tax treatment potential. Some preferred dividends qualify as qualified dividend income, or QDI. That matters because QDI is typically taxed at 0% to 20% federal rates depending on income level, compared to ordinary income tax rates that can reach up to 37% in 2026. That tax differential can significantly improve after-tax yield. Number 3, diversification benefits. Preferreds historically show moderate correlation to both stocks and bonds, making them a hybrid diversifier. For example, long-term correlation to U.S. Treasuries has averaged around 0.3 to 0.4 range historically. Correlation to equities is also moderate, not one-directional. This dual behavior helps smooth portfolio volatility across cycles. 4, lower volatility than equities. Preferreds typically sit between bonds and stocks in risk. Historically, less volatile than common equities, slightly more volatile than investment-grade bonds, but with higher income per unit of risk than many traditional fixed income allocations. In stress periods like 2008, however, preferreds can behave more like credit-sensitive assets, showing higher drawdowns due to financial sector concentration. Important 2026 reality check. Even today, investors need to understand preferreds are not risk-free. They are heavily concentrated in financial institutions. They are sensitive to interest rates and credit cycles. And many are perpetual with no maturity date, increasing duration risk. So while yields are attractive, risk is structural, not temporary. How investors use preferreds? Most investors access them through preferred ETFs, diversified income funds, or institutional credit portfolios. ETFs are the most common because they reduce single issuer risk, liquidity constraints, and sector concentration exposure. This is a key advantage of the ETF structure. Key takeaway: preferred securities occupy a rare middle ground. They are neither pure equity nor pure debt. They offer higher yields than bonds, lower volatility than stocks, and potential diversification benefits across portfolios. It fits many needs, but they achieve this by carrying hybrid risks that investors must understand. Because in investing, the best income isn't always where everyone is looking. It's in the space between risk and return that most people overlook.